Every empire needs a money machine. America was born by rejecting one. That is the contradiction at the center of the Republic. The United States fought Britain, rejected monarchy, distrusted aristocracy, and warned itself against concentrated power. Then, almost immediately, it built a national bank. This is unseen hand, revealing the hidden forces that shaped money, empires, and your future. Most people tell the story of American central banking as if it begins in 1913, with the Federal Reserve Act, a few men on Jekyll Island, and a new institution called the Fed. But that is not where the story begins. The real story begins more than a century earlier, when the United States was still a fragile experiment. Debts unpaid, currency unreliable, government young, independence not yet secure, because winning a revolution is one thing, financing a country after the revolution is another. America did not stumble into central banking by accident. It built it, feared it, destroyed it, rebuilt it, destroyed it again, and then spent the next century trying to recreate the same powers under a different name. The faces changed: Hamilton, Madison, Biddle, Jackson, Morgan, Wilson. But the question underneath never changed. Who controls the credit of the Republic? Go back to the 1790s. The British had left. The flag was new. But the young United States was drowning in promises. Revolutionary War debts, state debts, federal debts, soldiers paid in paper, creditors who doubted whether the government would honor anything. The country had political independence, but its financial skeleton was weak. Alexander Hamilton understood something many of his enemies did not want to admit. A government without credit is not fully sovereign. It can pass laws, it can make speeches, it can wave a flag. But when war comes, when taxes fail, when merchants demand payment and soldiers demand wages, a government without credit becomes a beggar. So Hamilton proposed a machine, a national bank. In 1790, Hamilton argued that a bank was of primary importance to the administration of public finances. In 1791, Congress chartered the first bank of the United States. It was not the Federal Reserve, not yet. It was a public-private corporation. The federal government owned part of it. Private investors owned the rest. It held treasury deposits. It helped move government money. It issued notes. It gave the young republic a more reliable financial center. And quietly, it did something even more powerful. It disciplined other banks. When state banks issued too much paper, the national bank could present those notes for redemption in gold or silver. Local banks could not print promises forever without facing a demand for real money. This was the hidden mechanism. The bank did not need to command every bank directly. It only needed to sit at the center of settlement, like a financial gravity well pulling weaker paper back toward hard money. Hamilton saw order. Jefferson saw danger. To Jefferson and Madison, this was constitutional power, class power, and the beginning of a financial aristocracy. If public power could be fused with private profit, who would really govern? George Washington signed the bank bill anyway. For 20 years, the first bank worked well enough to prove both sides right. Hamilton was right that the country needed financial architecture. Jefferson was right that architecture can become power. Then came 1811. The first bank's charter was about to expire. Recharter failed narrowly. Vice President George Clinton cast the deciding vote against it. The Republic had killed its first national bank, and almost immediately, the Republic went to war. In 1812, the United States declared war on Britain. This was not just a military test, it was a financial autopsy. Without the first bank, the Treasury struggled to borrow. Regional banks issued their own notes. War loans were harder to place. The federal government needed money, but the nation's credit system was scattered across states, politics, and local bank ledgers. By 1814, many banks outside New England had suspended specie payments. That phrase sounds technical. It was not. It meant the paper said it could be exchanged for gold or silver, but the banks would not actually give you the gold or silver. A dollar in one city was not always worth a dollar somewhere else. Notes traded at discounts. Trust became geography. Money became a map of suspicion. America had destroyed its national bank to protect the Republic from concentrated financial power. Then war revealed the price of not having one. So in 1816, Congress built the machine again. The second bank of the United States was bigger. Its capital was $35 million. The federal government owned $7 million. Private investors owned the rest. It had branches. It held federal deposits. It issued notes. It could restrain state banks by demanding specie. It was born from the wreckage of war finance. But the second bank carried a curse from birth. At first, it expanded credit aggressively, Land speculation grew. Then came contraction. In 1819, the United States experienced its first major peacetime financial panic. Farmers lost land. Debtors were crushed. Businesses failed. The bank survived, but its reputation was stained. To some Americans, the lesson was simple. A national bank did not prevent suffering. It could manufacture it. Then, Nicholas Biddle took over. Biddle was intelligent, cultured, disciplined, and convinced that the bank was necessary to national prosperity. Under him, the second bank became more stable, more efficient, and more powerful. It could smooth payments across the country. It could restrain reckless state banks. It could make American credit more believable. But every stabilizing power is also a coercive power. If the bank could expand credit, it could contract it. If it held federal deposits, issued trusted notes, and sat at the center of national finance, then it was not merely serving the Republic. It was becoming one of the Republic's organs. Then Andrew Jackson arrived. Jackson did not see a neutral institution. He saw a monopoly. He saw paper privilege. He saw a private corporation enriched by public authority. He saw a bank with political allies, newspaper defenders, and stockholders who profited from a charter granted by Congress. And he saw something else. Foreign ownership. This is where the story is often distorted. There are versions of this history that claim Jackson was secretly fighting the Rothschilds, that the Bank of the United States was controlled from Europe, that one hidden family pulled the strings. The documented truth is more subtle and more useful. The Rothschilds were real. They were enormously powerful in European finance. London was the center of global capital. American debt, state bonds, canals, merchants, and banks all existed inside a transatlantic financial system. But direct Rothschild control of the Bank of the United States is not documented. What is documented is this. The second bank had foreign stockholders, and Jackson made that fact central to his attack. In his 1832 veto message, Jackson warned that of the $28 million of private stock in the corporation, $8,405,500 was held by foreigners, mostly from Great Britain. That did not mean foreigners voted the bank's directors. The charter limited foreign voting power. But Jackson's fear was not only voting control, it was financial dependence. The United States had defeated Britain's army. But could it resist Britain's capital? Could a republic remain independent if its credit system rewarded foreign investors, enriched private stockholders, and operated beyond direct democratic control? This was Jackson's genius as a political warrior. He turned banking into sovereignty. In July 1832, Jackson vetoed the bill to recharter the second bank. "It is to be regretted," Jackson wrote, "that the rich and powerful, too, often bend the acts of government to their selfish purposes." Then he went further. "Many of our rich men," he said, "have not been content with equal protection and equal benefits, but have besought us to make them richer by act of Congress." That was the weapon, not economics, moral accusation. Jackson did not say merely that the bank was inefficient. He said it was unjust. He said government had created artificial privilege. He said law was making the rich richer and the powerful more powerful. Nicholas Biddle and Henry Clay thought they had trapped him. The bank's charter did not expire until 1836. By pushing recharter early, in an election year, they expected Jackson to choose between preserving the bank or angering commercial interests. Jackson chose war. He vetoed the bank. Then he won re-election. To Jackson, the voters had spoken. The bank was condemned. But the bank was not dead yet. It still held federal deposits. It still had branches. It still had allies. It still had the power of credit. So Jackson went for its bloodstream. In 1833, he ordered federal deposits removed from the second bank and placed in selected state banks, what critics called pet banks. His Treasury secretaries resisted. Jackson replaced them until he found one who would do it. Roger B. Taney carried out the order. This was not polite institutional reform. This was executive combat. And Biddle struck back. The bank tightened credit. Loans were reduced. Discounts were restricted. Money became harder to get. Merchants felt it. Debtors felt it. Newspapers felt it. Congress felt it. Biddle believed that financial pressure would show the country how necessary the bank was. But to Jackson, the contraction proved the opposite. Here was a private corporation, wounded by the president, squeezing the economy to defend its charter. The bank's defenders called it prudence. Jacksonians called it blackmail. According to later accounts, Jackson reduced the conflict to one brutal sentence. "The bank is trying to kill me, but I will kill it." Whether memory polished the line or not, It captured the reality of the war. This was no longer a debate about banking design. It was a fight over whether any financial institution could frighten the elected government into obedience. Jackson won. The second bank's federal charter expired in 1836. But here is the dark reveal. Jackson killed the bank. He did not kill banking power. He scattered it. Without the second bank, state banks expanded. Paper promises multiplied. Land speculation surged. Federal money flowed through selected state banks. Banknotes multiplied faster than confidence could follow. Jackson hated paper excess. So in 1836, he issued the Specie Circular, requiring payment for public lands in gold or silver. No paper, no illusion, hard money only. But systems do not always obey the intentions of the men who design them. Gold and silver moved. Credit tightened. Cotton prices fell. The Bank of England tightened. Confidence broke. In 1837, the panic came. Banks suspended specie payments. Businesses failed. Workers lost wages. Van Buren inherited the wreckage. The war against monopoly had ended, and the age of recurring panic had begun. This is the part both sides prefer to forget. The bank's enemies were right that concentrated financial power was dangerous. The bank's defenders were right that a nation without a stabilizing financial center was dangerous too. America had not solved the problem. It had only moved the danger around. For decades, the country lived with fragmented banking, state-chartered institutions, variable banknotes, regional discounts, and periodic crises. Then the Civil War came, and again, war forced financial innovation. Greenbacks appeared. National banking laws passed in 1863 and 1864. Banks could issue notes backed by U.S. government bonds. In 1865, a tax on state banknotes effectively pushed them out of circulation. The United States had created a more uniform national currency, but still, it had no true central bank. The system remained brittle. Currency was not elastic enough. Seasonal demands strained money markets. Panics returned again and again. 1857, 1873, 1893, 1907. Each crisis asked the same question in a different voice. Who is the lender of last resort? In 1907, the answer was not the government. It was J.P. Morgan. A private banker convened other private bankers and helped coordinate a rescue of the financial system. Nearly a century after Jackson destroyed the second bank because private financial power seemed too close to public authority, the country found itself depending on private financial power to prevent collapse. The machine had returned without a charter. That panic led to the Aldrich-Vreeland Act, the National Monetary Commission, the secretive Jekyll Island meeting, and finally, the Federal Reserve Act of 1913. The Fed was designed differently from the old Bank of the United States. It had regional reserve banks. It had a board in Washington. It promised elastic currency, lender of last resort capacity, and a safer banking system. But beneath the new architecture was the old argument: public power, private banks, credit creation, emergency support, democratic oversight, market discipline. The United States had spent more than a century trying to answer a question Hamilton raised and Jackson weaponized. Can a republic control money without creating a money power that eventually controls the republic? That is the real story. Not that America was secretly captured by a single family. Not that central banking was invented overnight in 1913. The darker truth is that America kept discovering the same problem and giving it new names. First bank, second bank, pet banks, free banking, national banks, private rescue, Federal Reserve, different structures, same pressure. Because modern money is never just money. It is a chain of promises, a hierarchy of trust, a political weapon hidden inside an accounting system. When credit expands, fortunes are made. When credit contracts, businesses die. When rescue comes, someone is saved first. When panic spreads, someone pays last. That was true in Hamilton's Philadelphia. It was true in Jackson's Washington. It was true on Wall Street in 1907. And it is true now. Every time a central bank cuts rates, raises rates, buys assets, backstops banks, opens emergency facilities, or decides which parts of the system are too important to fail, the old argument returns. Who benefits from the money machine? Who is disciplined by it? Who owns the claims? Who carries the losses? And who gets to call the whole thing neutral? America killed its central bank because it feared financial empire. Then it built the Fed because it feared financial chaos. That is the trap. Concentrate power, and you risk rule by credit. Scatter power, and you risk panic without a center. The question is not whether central banking is good or evil. The question is whether any society can build a money machine powerful enough to save it in crisis, without making that machine powerful enough to govern it in secret. Jackson thought he killed the monster. Hamilton thought he built a skeleton for the Republic. Biddle thought he defended national credit. Morgan thought he saved the system. Wilson thought he reformed it. But history whispers a colder answer. The machine survived all of them. If this gave you a new perspective, hit subscribe. History has the answers. We show you where to look.